Good to meet you all. I'm Reed Snyder. I'm the head of the energy transition investment team at Verdane. Who is Verdane? Verdane is a leading European growth equity firm focused on two primary investment themes that we believe are shaping the next 20 years of economic development in Europe and globally, which are digitalization and decarbonization. We think these are mutually reinforcing themes, and we're backing both of them by aiming to be the preferred growth partner to ambitious, tech-enabled businesses that will thrive in a sustainable world. We're 150 people located across 7 offices in Europe, and we're split into an investment team as well as a dedicated operations team that focuses 100% of their time on specific operational challenges that our businesses have in a hands-on way. We're actively investing 5 billion euros worth of capital, and we have 75 businesses in our portfolio across all of Europe and some in North America as well. And 4 years running, we've won the best European growth private equity firm in Europe. So, topic of the day, assets, right? We're all here talking about opportunities that in one way or another are going to help us decarbonize the economy. But where does all that carbon come from? It comes from our asset base. We have energy assets, energy and power assets, we have industrial assets, we have agricultural assets all over Europe and all over the world that are emitting carbon. Carbon is a physical thing, it comes from physical assets. How are we going to decarbonize our economy and reach net zero? We need to either replace our asset base or we need to retrofit it. It's the only way to get there. We can't digitalize our way to net zero. We'll never get there. So McKinsey has done a study, and they estimated that there's actually 28 trillion euros, 28 trillion with a T, that needs to be invested in Europe over the next 30 years in hard assets if we're going to achieve net zero. So if we in the finance and the startup community maintain the mentality that we had in the 2000s and 2010s, that asset light rules everything, everything needs to be asset light, we'll never get there. Because the incumbents, many of whom are in this room, they have some incentive to get there, but they need to be pushed. They need to be pushed by new entrants to the market because they have this sort of inherent inertia in their business that is the existing asset base that they've deployed. And that means that we need to back new innovative companies. We need to back new companies that are going to come in and help us retrofit and roll out new assets. And we as investors also need to recognize that it's not just going to go to the sectors where it's being deployed today. So if you look at where the emissions come from in the EU, 30% of them come from industry, but only 5% of funding is going to industrial decarbonization. Most is going to decarbonizing the power sector and the mobility sector. That's great use of capital, but we need to do more in areas of heavy industry, in buildings, in agriculture, et cetera. So, if you're one of these early-stage innovative companies that's trying to help decarbonize an area of the economy, maybe you're a hydrogen electrolyzer company, maybe you're an energy storage company developing new battery technology. When you start out, what is it that you're really focused on? You're focused on building a great product that your customers want. You're focused on how do I continue developing this technology, innovating in R&D cycles? How do I take the customer perspective and integrate that into my product design? And getting from an idea to a commercial product can be like, sitting in Britain and looking across the English Channel, and you got to swim all the way across it, right? It's a long way to go, but you're swimming, you get there. Finally, you get there, and it turns out you're actually not in a swim race. Someone hands you a bike, you're in a triathlon. You've finished one part of it, but you've got a long way to go, actually. And the game changes completely, right? So now it's not about how do I build this battery technology, how do I prove that there's something that people want to buy. Now it's about how do I get these assets out there into the real world. It's a totally different set of challenges. How do you manage production? How do you manage financing? How do we structure your organization in a way that shifts away from an R&D focused and product market fit focused organization into one that's focused on deep, heavy operations and scaling? On top of that, you have to start thinking about a whole host of new problems. So how are you going to, if you're going to deploy these assets out there, these are long-lived assets, you have to think about hedging. You have to think about credit risk of the people that are taking them off. You have to think about, what's the going interest rate in the economy, and how is that going to affect people's access to capital or my access to capital? What are the long-term duration of these contracts? What sort of collateral value do the assets have after I've deployed them? And will banks see it the same way? It's a totally different set of challenges, and companies that are faced with it, I think, very quickly recognize that in order to deploy all of that and deploy that asset base, there's a massive amount of capital that needs to go into CapEx. So the venture and the growth community is primarily built up around funding OpEx, operating expenses, and typical operations that would happen in the main part of your business. But when you look at the capital need, it can be that in some cases up to 90% or more of the capital need of really scaling a decarbonization-focused business is actually deployed into the assets, right? It's getting the batteries into people's homes, it's getting the solar panels on the roof, it's getting the carbon capture equipment up on the points of emission where it's actually being emitted from factories around Europe. The difference here is that there are different risk profiles to these two types of businesses. So if you're putting solar panels on a roof, those are assets that have 25 to 30-year lifetimes. They're going to produce electricity with a high degree of reliability. You can model within a 90% confidence what the output of that is going to be. You can sign a PPA agreement and get someone to commit to purchase the offtake of that electricity at a set price. So you're talking about something that has significantly less risk than a venture capital company or a startup company that's intentionally burning a lot of capital in order to try to grow quickly, expand to new markets, add new products. So what we increasingly see in the market is the need for businesses to, much earlier on, tranche out their operations from their CapEx. So to think about assets living in one company and operations living in another. And then for these two to interact with one another through different capital structures and different financing providers at each level that more accurately reflect the risk level and come with different costs of capital from often different investors. The challenge of this is that these fundraising processes can become codependent. So if you try to set up an asset co in order to scale your solar PV factories, the lenders of that may look at your business and say, well, how well capitalized are you as a growth company, and how can I trust that you're going to actually deliver on everything you promise with this growth that's going to come in the years ahead? Conversely, when you go to a growth investor and you tell them you're going to grow by deploying a bunch of assets, they're going to say, okay, well, who's paying for them? And you say lenders. They say, okay, well, where are the lenders? Have they committed yet, right? So it can become a chicken and the egg type situation where both people are waiting for the other one to take a move, and it can be challenging to sort of break through that and get your first funding. So how can companies faced with this dilemma optimize the situation? So typically, when you think about debt financing processes or infrastructure type funding processes, there are three considerations that businesses have to consider when choosing between different options. So that is, what is the quantum of debt that I can get? So if I need to spend 100 euros on a solar panel, can I get 90% of that covered by the facility, or can I get 70% of that covered by the facility, or only 20%? So that's the quantum. Then there's the cost. Are you going to charge me 8% interest? Are you going to charge me 10? Or are you going to charge me 12? And then flexibility. So can I sell that energy to whoever I want, or do I need to sell it to that person there, or can I sell it to a nearby home instead? How much flexibility do I have to then manage my business how I think is best and skate to where the opportunities are? And even mature companies typically have to choose 2 out of the 3 of these. They need to make a sacrifice in one of them if they want to secure a facility from a bank or an infrastructure provider. If you're a young company and you don't have as much of a track record, you may have to just choose 1 out of the 3. So you're faced with really important trade-offs and really challenging trade-offs very early on in your scaling journey. So I think we should take inspiration from how some areas of the energy transition and decarbonization space have succeeded with this. So there have been billions and billions of euros deployed behind wind energy in Europe. I think that's something we're all familiar with. So how did that happen? Well, it wasn't venture capitalists and growth capitalists putting that money into developing big wind parks. It's primarily lenders, infrastructure players, and credit providers such as banks. And how did they get comfortable investing into these assets and facilitating the rollout of wind power in Europe? Well, the developers that put these projects together were able to secure a high percentage of their revenue and cost. So when it came to securing the revenue, they were able to sign long-term power purchase agreements with users and purchasers of electricity. So they could say, as long as the wind blows and we produce it over the course of a year, and they can model with pretty high certainty what the production will be on an annual basis, then they knew that there would be someone willing to purchase it at a specific price. So they can quite accurately model how much revenue they're going to have. That's something the banks and the infrastructure providers really like to see. And in terms of cost, they were able to go to EPCs, go to OEMs of the actual wind turbines, and agree with them and say, if we build this, can you guarantee us that the cost is going to be at a certain level, so we're going to pay a certain amount per unit of capacity that we install. So they're able to lock in their cost base, they're able to lock in their revenue base. And by doing that, the lenders were able to provide them with large amounts of debt capital at low cost. But as we've just said, they had to lock in all these things, so what have they done? They've given up flexibility, right? That was a choice they made to unlock large amounts of capital at a low cost. You could make different choices in your business depending on the nature of the types of assets you're deploying. But I think this is an area where people can take inspiration and think about how you could try to make your case more bankable, make your assets more bankable, and therefore secure cheaper access to funding to help roll them out. I think at Verdane, this is something that we think about with our companies on a regular basis. So we have two companies here that I'll give as an example, one of them in the room with CleanWatts. CleanWatts is an innovative company in Portugal who has developed technology around renewable energy communities. So they have a vision of local energy markets where you have locally produced renewable energy, and you sell that energy not only to the business or the municipal entity whose roof it's on, but you also sell it to the local community. And you do that in a way that is relatively complex. You have to enable peer-to-peer transactions and settlements toward the utility companies. CleanWatts has developed a proprietary software solution that does that. But they cannot just knock on people's doors and offer them a software. There needs to be an asset there in order for their technology to be applicable. They need to get solar PV on the roof. They need to get storage into people's facilities. They need to deploy EV charging units. So how do they do this? They need to finance it with an as-a-service model. So we're working actively with CleanWatts on how do we get project finance and other types of debt structures in place so that they can roll out solar PV to communities and then set up energy communities around this. That's something that they shouldn't have to take growth capital to put all of this solar out there, right? These are relatively safe assets with long duration. They know that they're going to be able to monetize them. There's debt funding out there. We're just helping CleanWatts, and they're working very hard to sort of get up there and prove to the banks that they are bankable. Nornorm is another company that Verdane is invested in. They do office or furniture as a service. So if you're a startup company, you may not want to commit to purchasing a bunch of furniture. Who knows where your office location will be and what you'll need in a couple of years. These guys provide it as a service. So for them, it's the same thing where we have to convince the banks that we have long-term contracts with our customers. They're going to be there to do it, and if for some reason our customers no longer need the furniture in a certain amount of time, we can redeploy it and get it back into the system and get it back into the hands of a paying customer. So that's something that we're working actively on with banks to help them finance. I think if you're a company that is looking to deploy decarbonization assets, if you're struggling with this, reach out to us. It's something that we spend a lot of time on. We have 2 dedicated in-house people that work 100% of their time helping our portfolio companies, specifically on non-equity funding related topics. So I think it's a major topic, and we're not going to get there unless we help each other out. And at Verdane, that's what we want to do. So please reach out. Thank you.